Hello guys, this is Mehmet Yılmaz. Today I would like to talk about the effect of the world financial crisis in 2008 on BRICS countries and Turkey. Uh, let's look at the beginning of the 2008 crisis. In the late 90s, there was an economic recession in the USA. The main reason for this was the dot-com crisis. Dot-com is used with the reference to the internet-related companies. After the third industrial revolution, information technologies developed. Internet companies proliferated in the mid-90s. Some of these internet companies were solid companies, such as Amazon, uh, while some of them were financially weak. Internet sector was on the rise. Stocks of internet companies started to be traded on the stock markets. But not all of these companies had solid infrastructure, and companies that were not solid went bankrupt after a while. Investors who brought their stocks also suffered losses. The internet industry chased to be profitable. The dot-com bubble started to grow in 1994 and burst in 2000s and 2001. This overlapped with the events of September 11 and 2001, and the American economy was dragged to a deep recession. The Fed followed a low interest rate policy, which is 1%, to stimulate the economy. The aim was to increase production mobility, enabling companies to borrow loans and low interest rates and continue investments, and also increase consumption by allowing consumers to borrow credits at low interest rates. Why that's important? Because that came with the how did the crisis occur? In the early 2000s, the demand for houses was increasing, so prices of houses were increasing and the construction sector was booming. As the prices of houses increased, construction companies continued to produce houses, that is, the housing supply increased. In 2006, the house prices started to be fall. The flow of credit to the banks started to be decreased. As a response, banks started to give mortgages to poor families without asking any proof of income or down payments. These are called subprime mortgages. Subprime mortgages were not paid back. Prime mortgages were not paid back either, because prices of houses fell. When no money flowed to the banks, the whole system collapsed. The derivative papers related to risk debt repayments, especially the riskiest one, went bankrupt, and investors who held these risky papers went bankrupt. Consequently, construction companies, consumers, bank credits, rating agencies, institutional investors, and insurance companies were all affected by the crisis. Let's look at the effects of the crisis on the world economies. The global crisis, it was damaged macroeconomic data such as growth, inflation, borrowing, and trade volume in developing countries as well as developed countries' economies, making it difficult for many countries to achieve their public finance sustainability targets. In the period between 2007 and 2010, public debts of developed countries increased twice as compared to the increase in gross domestic product. This increase, especially in the public debts of developed economies, was mainly attributed to the practice to trying to save financial institutions by the state. On the other hand, negatives such as the decrease in public revenues, along with the declining economic activities, the increase in public expenditures, with the exorbitant increases in social expenditures, such as unemployment benefits, the increase in the public debts by disrupting the budget balance of the financial incentive package for tax reductions were also effective in the increase of the in-debts. Let's look at the effects of the crisis on the Brazilian economy. Brazil, one of the largest economies in the world, it emerged from the 2008 crisis like other developing countries with a negative impact. Although the Brazilian economy felt the negatives on the crisis in areas such as foreign trade, uh, foreign investments, and banking sector, these effects were limited compared to the many countries. Brazilian economy, it grew by 4% in a 5-year period between 2003 and 2008. With stable and high growth rates, foreign investments entering the country increased by 10% in this 5-year period. In this period, the high rates of increase in exports along with investments paved the way for a good performance of the Brazilian economy. Let's look at the effects on the crisis on the Russian economy. Russia, thanks to the high level of current account surplus, high level of capital flow, and the size of international reserves, it entered the crisis period strongly and shined like a star among emerging economies with these features. Russia, which is one of the fastest growing economies with its lands, covering a wide geography starting from the north of China and extending to the Eastern Europe and Scandinavian countries. In this country that has managed to enter BRICS with its rich natural resources, qualified workforce, and high-level financial resources, the basis of economy in Russia depends on the sale of raw materials. This situation was the most important factor in the country economy in the 2008 global crisis. The collapse in the world's crude oil prices towards the middle of 2008 caused the export growth rates of the Russian economy, which made a significant part of export revenues from oil sales to decline to 30% to 36%. Now we can see a chart about the industrial growth of Russia. Now let's look at the effects on the crisis of the Indian economy. India, although it experiences a serious economic crisis in the 1990s, it is a country that has implemented important reforms in the fields of industry, trade, and investment in the ongoing process. These reforms basically aim to liberalizing the economy and integrating with the global markets. In addition to these reforms, India, which has managed to attract significant technology and financial investments, thanks to its liberalization practices and its open economy, it has significantly improved its economic performance, especially in the last 30 years. The main effects of the 2008 crisis on the Indian economy: information technologies, investments, exports, unemployment, foreign capital, exchange rate, and stock market. The country's income from the US-based financial institutions in the field of information technologies correspond to approximately 60% of the total sector earnings in the country. With the recession in the USA during the 2008 crisis, 70% of the US companies reduced the contract rates they signed with Indian IT companies, while 6% of them canceled their contracts completely. Let's look at the effects on the crisis of Chinese economy. With the global crisis, the rate of increase in exports, which decreased to the 70% approximately in 2008, although it closed the year 2009, when the crisis depended with the regression 15%, it made a new leap in the 2010 and increased by the 31%. Chinese economy in the 5-year period between 2005 and 2010, it grew by 10% on average, and the foreign investments of $250 billion in this 5-year period. The country's reserves rose at a level of $2 trillion, and Chinese 1.7% of its GDP in 2000. In 2008, it had a current account surplus of 10%, according to the IMF. The high rate of savings, as well as the fact that the local currency is not allowed to depreciate due to fixed exchange rates, was also effective in the high current account surplus ratio. Now let's look at the effects on the crisis on the Turkish economy. When we look at Turkey was not affected much the crisis in the financial sphere in 2008. The financial effect of crisis was revealed after the 2013. This is because it was not highly integrated into derivatives markets, and it had already established the Banking Regulation Supervision Board in 1999. But Turkey was negatively affected by the trade relationship between Europe and Turkey. This crisis reduced Europe's demands for export products from Turkey. After 2013, the financial sector was also affected because until 2030, the Fed pursued a low interest policy. In 2030, it increased the interest rates on US dollar. The higher interest rates on the dollar led investors to the dollar, even if there was only a slight increase in the interest rates. Until 2030, investors were investing in other countries' currencies because the dollar's interest rate was low. So countries such as Turkey had hot money inflows. This increased the rate of growth in such countries not through industrialization, but by abundance of capital inflows. From 2013 onwards, emerging markets such as Turkey were negatively impacted by the increasing interest rates on US dollar. When we get to the conclusion with the 2008 crisis, there was a contraction in demand, global foreign trade, and this contraction, along with the BRICS coalition, caused deterioration in Turkey's foreign trade figures. The global crisis also affected BRICS and Turkey economies like many developed and developing economies. However, the fiscal strength, moderate inflation, and macroeconomic stability that emerged in pre-crisis periods significantly alleviated by the severity of these effects. Now we can see my references from there. These are some researches. That's all. Thank you for listening to me. Have a nice day.